Afternoon, and thanks so much for joining us today. My name is Michelle Fuller. I'm Managing Director of Strategy and Operations and a Senior Wealth Advisor here at Bartholomew Company. We're pleased to have you with us for today's webinar, Markets in Focus, looking ahead to 2026. And we certainly appreciate you taking the time to join us. I have the pleasure of moderating today's webinar with two of our firm's investment leaders, Alex Bartholomew and Kyle Cornell. Alex Bartholomew is our Chief Investment Officer who oversees investment strategy and portfolio management across both our private wealth and institutional client portfolios. Kyle Cornell is our Director of Research and Trading, who leads portfolio implementation, research, and ongoing monitoring across client accounts. Together, Alex and Kyle bring decades of experience navigating various market cycles and translating their research into disciplined investment decisions. Now, before we get started, I wanted to note just a few housekeeping items. Today's session is being recorded, and so we'll send out a replay with all registered participants following the event. Today's webinar will be presentation-based. We will not have any live Q&A. We do appreciate those that did submit questions during the registration process. We have them, and we will definitely be addressing them throughout our presentation today. And then finally, if you experience any technical issues, feel free to refresh your browser, or you can also rejoin using the original link. Whether you're a longtime client of ours or joining us for the first time, our goal today is simple. We want to provide you with clear perspective on today's market environment and thoughtful insight into what may lie ahead as we move into 2026. Before we get into the market commentary, I do want to briefly share a little bit more about who Bartholomew Company is as a firm, and importantly, what shapes our perspective. Bartholomew Company was founded more than 30 years ago in 1994 with a clear focus on long-term relationships, independence, and our clients' best interest at the center of everything we do. Today, we steward approximately $5.7 billion on behalf of institutions, individuals, families, business owners across the country. And we have one shared purpose, applying the same standard of care, discipline, and accountability to every one of our client relationships. While we operate nationally, we remain deeply rooted here in Central Massachusetts, with offices in Worcester and Framingham and affiliated offices across the state of Massachusetts. Our team is intentionally collaborative, with 42 professionals, including 20 dedicated advisors, all working together to deliver thoughtful, disciplined advice. Now, what truly differentiates our firm is our institutional roots and foundation. A significant portion of the work we do is for institutions, municipalities, and organizations that demand rigor around risk management, rigor around governance, rigor around process. You'll note that specific breakdown in our assets under management pie chart on the right, $3.4 billion with institutions and $2.3 billion with private wealth. Now, that institutional mindset informs everything we do, including how we serve private wealth clients. It's not about complexity, but rather about clarity, about discipline, and about consistency across market environments. Now, with that context and that framework in mind, I'm excited to turn things over to our investment team. Kyle's going to kick us off with what's driven markets over the past year and some commentary on what's changing as we look ahead, while Alex will provide a lens into how we're viewing 2026 and how we're thinking about portfolio positioning in today's environment. So with that, I'm going to turn it over to you, Kyle. Walk us through key economic themes from 2025.
Absolutely. And thank you, Michelle, for that introduction. And thank you all for joining us today. At the end of every year and beginning of the next, investors and strategists alike typically form a consensus view on the economy and their outlook for markets ahead. 2025 was no different, and where we sit today in 2026 is no different. So coming into the year, the consensus view on the economy was that the inflation rate would slow closer to the 2% level, unemployment would moderate and hover around the 4% level. And then as a result, growth, or GDP, would slow to a real rate of 2%. That outlook reflects an economy that was expected to soften to normalized levels, one that was not going to be too hot or too cold, and exactly what the Federal Reserve and other policymakers had been trying to achieve after years of strong growth and high inflation. And then from an investment perspective, the momentum trade coming into the year was a continuation of American exceptionalism, or the idea that US markets, US companies would continue to outperform the global economy. Now, looking at this first slide here, we can see that for the most part, that outlook materialized. Inflation was stable, but hovered in that 2.5% to 3% range, and then ended the year at 2.7%, slightly higher than the 2% level that consumers and policymakers prefer to see, but much closer to longer term targets, especially compared to where we were just a few years ago at peaks of inflation. Now, tariffs did play a role in preventing continued disinflation at times throughout the year. However, they weren't enough to put tremendous amount of pressure on overall goods and services to send us back to those peaks that we saw in 2022. Now, at the same time, on the right-hand side, labor demand slowed, especially compared to recent years, which did end up putting some pressure on the unemployment rate. The graph on the right here shows average monthly job gains in each of the last 3 years. We've gone from an average of 220,000 jobs added per month in 2023 down to 168,000 in 2024, and now down to just under 50,000 in 2025. Again, there were some points in the year where we saw unemployment claims move higher, which did affect the unemployment rate to some degree. However, it was never near recessionary levels or any broad levels that would cause a large spike in the unemployment rate. So all in all, we got a more normalized backdrop in 2025 and one that didn't really break the narrative coming into the year.
Thank you, Kyle. So what I'm hearing is the macro conditions seem solid, but what did that mean for GDP and how the economy actually measured in 2025?
You're right. Like you said, those were just conditions, but they did set up for a favorable growth environment overall, even if the growth rate would be slightly lower than in prior years. As I said earlier, expectations coming into the year were for a real growth rate of 2%, a pretty average number by historical standards. However, that expectation was rooted in an expected slowdown in consumer spending and business investment, neither of which really happened in 2025. Consumers continued to spend as the economy remained near full employment levels, and real wages also continued to expand at a positive rate. And at the same time, the economy saw massive amounts of business investment and spending on AI development and infrastructure, which did provide a large contribution to GDP overall. Ahead of the presentation today, we did receive a handful of questions about AI, so I did want to address it a little bit here. It certainly was a driving factor to GDP last year and overall stock market returns. And much of that growth impact from AI in 2025 was solely around the infrastructure and development of AI capabilities. So it's likely that right now we're still in the very early innings of any productivity gains that may come from business and consumer implementations going forward. Now, if we're looking at this slide here, we can see the green bar, which represents consumer spending, and the dark blue bar, which represents non-residential fixed investment or business investment. And those are consistently large contributors to GDP. When business conditions are favorable and people are working, that is typically a very solid base for overall economic output, which is exactly what we saw through the first 3 quarters of 2025. Now, there were large swings here in the red bar in net exports, which did make the data a little murky, particularly in the first quarter and second quarter. But the core of GDP, those green and blue bars, remained very solid, which led to the continued growth in 2025, like we saw.
So, with favorable conditions and an economy that met or even slightly exceeded expectations, we should have seen a positive environment for investment portfolios, right?
Absolutely. And it certainly was a very strong year for portfolios. In any given year, there's volatility, there's events that put pressure on equity and fixed income markets. 2025 was no different. It had its fair share of events and pressures from a change in the White House to tariffs, other global geopolitical risks, and then there was AI. So there were plenty of events that were both positive and negative for markets throughout the year. Looking at this simple bar chart here, we can see, though, that all major asset classes were positive last year, and a balanced portfolio delivered anywhere between 13-14%, depending on specific asset allocations. Now, international equities led the way, up 32%, while US equities and then commodities closely trailed, up just above 15%. Equity returns, specifically US equity returns, were fairly concentrated last year with, across AI names like NVIDIA and Alphabet and Broadcom. Those three names contributed just over 30% of the total return contribution to the S&P 500. Now, wrapping it up here, your portfolio diversifiers in fixed income and alternatives also delivered a very attractive return in the 7 to 9% range, as high fixed income yields coming into the year presented a very attractive starting point for forward-looking returns. And one thing I do want to highlight on this slide in particular is that it takes me back to my original comments at the beginning that coming into the year, the momentum trade was all about American exceptionalism, meaning US companies, notably tech stocks, were going to continue to be the best performers and were likely going to continue to outperform. When in actuality, the top two performing markets last year were developed international equities and then emerging market equities. This rotation out of the US and into international happened right around Liberation Day, or the day that President Trump announced his tariffs that he was going to roll out in April. Investors quickly pivoted away from American exceptionalism to a sell America trade. The dollar weakened, and that's when non-US equities began leading the charge to their 30+% returns. And so I think one big takeaway from 2025 was that it was a good year to be diversified, even though all major asset classes did deliver a positive return. Many investors were underweight international equities coming into the year after years and years of relative underperformance to our domestic markets. This rotation caught a lot of portfolios offside. So I think it's just a major reason that why staying diversified and disciplined in your approach is important, because what worked yesterday is not guaranteed to work tomorrow. And last year's global equity rotation, I think, was a key example of that.
Always great and always key to be diversified, that's for sure. Well, thank you so much for that 2025 recap, Kyle. Let's now turn it over to Alex, who's going to discuss some key narratives for 2026 as it relates to the outlook for the economy, monetary policy, interest rates. Alex, I'll turn it over to you.
Thank you, Michelle. And thank you, Kyle, for the presentation on 2025. And again, thank you for everybody for joining us today for our market outlook and look ahead to 2026. We're going to start today on the look ahead, looking at the overnight lending rate as set by the FOMC, the Federal Open Market Committee Board. As you may or may not know, this is the policy benchmark, which all interest rates are benchmarked off of. And what we're looking here is back to January of 2021, prior to this rate coming off of zero, peaking at 5.25% in 22 and 2023 to fight off inflation. Now, as a reminder, the Federal Reserve's dual mandate of price stability, or maintaining inflation at a reasonable level with their target of 2%, plus maintaining full employment as measured by the unemployment rate. Back in 2022, interest rates rose with beyond full employment, very historically low unemployment rate. I mean, everyone in the economy was being employed, and Kyle shared the job gains we had back then in 2023. But as we've gone into 2024 and 2025 and now into 2026, we've seen the labor market continue to weaken, and we've seen inflation materially come down off of its highs in 2022. We now sit at an overnight lending rate on the lower limit of 3.5% at the end of the last year. And we expect, in conjunction here with the FOMC's own projection and the market participants' projection, that interest rates will continue to go down on the overnight lending rate. To what extent is up for debate. There are many factors that go into this. The factors to inflation, factors to GDP growth, corporate earnings, and of course, the labor market. If we continue to see real material weakening in the labor market, that could be the real indicator that gets us from 3.5 lower than current expectations of 1 to 2 cuts. And don't discount the very material impact of the current chair, Jerome Powell, his term ending on May 31st of 2026. We do not yet know who is going to be nominated by the White House for this role, but expect that that person will come in with an understanding that lower interest rates are better for consumers, businesses, and continued economic growth. So if for your cash investments at a bank in your investment portfolio, understand that yields should, in all likelihood, continue to come down. Now, on the next slide, we're going to step a little bit further out on the fixed income curve, the interest rate curve, getting out of cash, and talk about other fixed income investments and sectors. On the left-hand side here, we have what is a regression analysis. It represents the Treasury market from a current 5-year Treasury starting yield and what you would expect to make over the next 5 years. As you might expect, this correlation is very, very high and mathematical. So where we sit today is a little bit below 4% on a 5-year Treasury. Gross of fees, you would expect to make around 3.8 if you bought a 5-year Treasury today. This still remaining the globally accepted risk-free rate and benchmark for safe haven assets. However, your fixed income investment portfolio most likely doesn't own just Treasuries and is diversified across all of these other fixed income sectors, whether passively held or actively held. The story on spreads, or the value at which you're being compensated to buy over and above the risk-free rate, is a very interesting story right now. We have seen over the last couple of years in the demand for yield, the demand to allocate cash, spreads have continued to tighten. On the right-hand side here, which dates back to December 31st of 2000, we can see the bar charts, the bar graphs, the range of spreads that we've experienced over these last 25 years. The upper limits are at the worst times in the market, like in 2008 or in the liquidity crisis in 2020. And where we sit today are historically tight spreads. So investors buying risk in the fixed income market are being compensated less than they have throughout history. So what does this tell us on how to position portfolios and how are we talking to clients about fixed income investments in 2026 and beyond? Active management is going to add value through security selection. We remain overweight quality, meaning overweight treasuries, government securities, agency mortgages, because we're not being compensated the way we should to take risk, like credit risk in high yield corporates as an example. But at the same time, we see starting yields that we haven't seen for most of the last 15 years. So from a level perspective, fixed income adds enough diversification to risky assets, which we're going to talk about in a minute, and whether they are cheap or expensive. But the diversification in out of benchmark and out of government exposures have to be moderated.
Alex, thank you. Thank you for that perspective on not only interest rates, but the role bonds play in our client portfolios and how we're looking at those specifically. Now, what about the stock market? Kyle talked a little bit about some of the questions we saw come in from clients. Many of them were around AI, specifically, is there an AI bubble? Is the AI trade too late? How can I diversify away from AI concentration? We know AI has been such a hot topic on minds of investors. Can you walk us through where equity markets are today and what the environment looks like going forward?
Certainly. On this next slide here, we have two very helpful long-term historical measures of valuation of the domestic S&P 500 stock market. The AI trade, as Kyle indicated, has been and continues to be the main and almost only theme driving stock market earnings and performance here in the United States. the concentration of the top 10 names, which are mostly dominated by artificial intelligence spend or investment, make up most of the market cap and most of the earnings and most of the returns. So it's called a thinly supported market. And that concentration risk that we are experiencing right now has really never been seen before in the market. If we look on the left-hand side here, this is called the Shiller-Cape ratio, which stands for cyclically adjusted PE ratio. It's different than the traditional PE ratio in that it takes into account inflation and interest rates at the time of calculation. The importance of this is it's easier for us to compare the current market environment to previous market environments, taking those two data points into account. If we compare the current decade starting in 2020 to the last 2 decades of this millennia, we can see that we are at the richest or most expensive point in the S&P 500 outside of the tech bubble. I'm not in any way indicating that we are in a similar situation, market environment, or exposure to companies as the tech bubble, simply that this current index is very, very expensive. I'm also not indicating that it's going to go down because it's expensive. The AI trade continues to deliver in earnings with strong balance sheets and strong future guidance. On the right-hand side, it's another measure that's really telling us the same thing, which is an expensive stock market here in the United States. This is often called the Warren Buffett indicator because of how he's made it famous, which is the cumulative market capitalization of all of the companies in the S&P 500 as a percentage of real GDP, which is economic growth minus current inflation. And as you can clearly see, it is at the highest point it's been in the last 20 years. So there's risk there. There's concentration risk. There is valuation risk in the United States large and mid-cap stock market. What we are going to see on the next slide is forward-looking 10-year returns on both U.S. equities, both large, mid-cap, and small-cap, but other exposures. So if the U.S. stock market is expensive because of this AI trade, what should investors do? Where is their opportunity? What should the expectations be going forward? In the middle of this graph, which has volatility on the bottom on the x-axis and expected 10-year forward-looking returns, which is modeled out on the y-axis, what we're going to see is that developed U.S. equities and emerging markets U.S. equities are expected to outperform domestic equities as an American investor for a number of reasons. That could be valuation reasons, currency reasons, or supply and demand for the sell America trade going forward. However, compare the grouping there and how tight those expectations are to other parts of the scatter plot. I'm going to first draw your attention to the blue dots on the left in aggregate bonds, which represent diversified core bonds, government securities, corporate bonds, mortgage-backed securities, and then corporate high-yield bonds or below investment grade. We expect a lower volatility profile to complement our equity exposure, which is why we build diversified portfolios for our clients. But also, look at the y-axis. We're expecting over the next 10 years between 4 and 6% returns for fixed income. That is a materially different starting place than we were even 3 or 4 years ago. So investors have become significantly more comfortable with risk since 2008, largely due to zero interest rate regime. And we are encouraging all of our clients to continue, if they can, to consider their current risk profile and whether they have too much exposed in the US stock market, both on valuations and opportunities in other asset classes like fixed income. And then lastly, I'm going to draw your attention to, if you don't mind going back to the last slide. Thank you. To the private markets. We have non-traded US real estate, direct lending, which is another term for private credit, infrastructure equity, and then one version of private equity called buyout. As you can see here, the opportunities to really diversify a portfolio, we talk about the concentration risk in the US equities, and yes, you can diversify by going international, but the real diversification is in private equity, the private markets. Same thing in fixed income. More and more companies are accessing private debt and equity financing and not going to the public markets. On top of that, we as investment advisors in this industry can provide exposure to more investors than we historically could, when appropriate. So if you haven't already, please talk to your financial advisor about the potential opportunities that make sense for you, because this is really the way to diversify, particularly risk exposure in a diversified client portfolio in 2026 and beyond. Now, as a wrap up of 25 and 26 on the next slide, just to recap what Kyle was saying earlier, in 25, inflation was stable, but it was higher than targeted levels coming into the year, mostly due to the impacts of tariffs that were not seen before 2025 started. Labor activity did cool with weaker demand. And if you peel back certain sectors like government hiring and healthcare hiring, monthly average job gains were negative. So we're going to continue to watch the more granular data of the labor market very closely. And with all the volatility that we had in geopolitical risk and inflation and tariff risk, GDP was strong and resilient with consumer spending and AI business investment. Multi-asset class returns were positive and very attractive. We saw very strong returns across equity buckets and high single-digit returns in fixed income because interest rates reduced and got lower across the year. And then lastly, international equities did outperform US as we've mentioned several times. On a forward-looking basis, continue to expect lower interest rates in cash, even though we expect the rate of change to slow. And if the labor market weakens unexpectedly, consider that interest rates will go down faster than otherwise. US equities do look expensive, particularly with the concentration risk at the top of the market cap table, and look out elsewhere for diversification, whether that's fixed income exposure, international equities, or even the private markets if they're appropriate. And then lastly, fixed income levels remain attractive, even though we saw rates come down throughout 2025. However, because of spread levels, we are prioritizing quality over risk.
Perfect. Thank you, Alex. And thank you, Kyle, for your comments earlier. So as we come to a close on our Outlook discussion today, I want to start by simply saying thank you to all of our viewers, not just for joining us for today's discussion, but for the trust that you place in us year after year. We never take that lightly. Markets will continue to move, headlines will come and go, and uncertainty is often part of the journey. But what remains constant is our commitment to being thoughtful stewards of your capital and trusted partners as your goals, your priorities, and of course, your circumstances evolve. If today's discussion raised questions, sparked new thinking, or made you potentially want to revisit some of these themes and how they connect to your own plan, we encourage you to reach out to your advisor directly. Many of these conversations, especially in times like these, are where the real value is created. For those of you that may not be existing clients of ours yet, you'll see our general contact information here on the screen. You'll also note that we'll be sharing a recording of today's session so that you can, of course, revisit it, but also share it with a family member or even a friend if you like. On behalf of the entire Bartholomew Company team, thank you for being a part of our community. We truly appreciate your continued confidence in us, and we look forward to staying connected. On the next few slides here, we have our disclosures as well as definitions on some of the things we spoke about. These are all noted here for compliance reasons. I'll close out today's session again, thanking all of you for joining. Enjoy the rest of your day, and we hope to speak with you soon. Take care.